So let's start with kind of a reiteration. What is credit? Emily talked a lot about this in terms of basically using other people's money for a fee. So we hear a lot of things in society today, buy now, pay later. There's this inherent trust to that relationship that there's also a deferred payment. So we get the excitement of making the purchase up front, but we did it with somebody else's money. So there's this tie-up of future income in these credit relationships and in trust that you're going to repay them. So I want to kind of take my lecturing hat off to some degree and kind of tap into a former life as a loan officer. My first job out of college was a loan officer, and I saw people do credit really well, and I saw people do it really badly. So I don't want to assume that you have models in your life that are doing it well. I want to kind of talk through some of the things that are going to be used to, we tend not to be a real judgy society, or we try not to be want not to be a judgy society, but there are things that when you're looking at credit, you need to look at them through a banker's perspective. And how are they seeing you in your management of your financial relations? So I want to take a look at some of the things that are going to impact the types of products that you're going to buy. The types that are available are generally installment credit. So things like your student loans, mortgage loans eventually, maybe those car loans, things that have a defined point in time where the loan starts, the loan ends. But there's a repayment, you're going to make equal monthly payments in between that start and end point, and then it's going to be done. And then credit cards. Everyone's first temptation to engage in a credit relationship, is the credit card because the application process seems a little bit easier and a little bit more prolific in the offerings. But the revolving credit, the credit card type of products that are out there, there's plenty of choice. The interest rates usually aren't all that great, so you're tying up more of your income to use somebody else's money. But that relationship starts at a defined point in time, and it just kind of rolls forward into perpetuity until one or both parties break that up. So a lot of people have a question of how to get started, and we're going to talk about getting started with the application process. The application process is going to look at what we call the 5 C's of credit. A banker is going to start looking for not just your name and your address information, although that's important because it helps them match your credit file and make sure they're talking to the same person that they think they're talking to, but they're going to look at that credit file. They might even, if you don't have a credit file already established, they might say, well, let's call a previous landlord. Or let's talk to some utility companies. Let's try and assess if this is an honorable person. Do they handle their financial affairs with some level of integrity? Do they pay people back when they say they're going to pay people back? So that's the character piece to this puzzle. The capacity is almost always going to be a conversation around your income. How much do you have? How stable is that job? How long have you been in that job? I will tell you from a banker's perspective, 2 years is kind of a nice starting point to have some perspective in terms of the longevity of your income prospects. So if you can stay in your jobs a little bit longer and make that flow of cash a little bit more continuous, that's going to bode well for you in a credit conversation. Sometimes they'll look at the other debts that you have. So like Emily was profiling, most people don't just have one debt in their mix. They have 3 or they have 4. So you have to look at what that income is really bearing. How many other debts are kind of in the priority ranking before this new debt that you're asking to take on. So that's kind of where the capacity falls into place, although there are days, and I have to tell you a story because when in the lines of people that don't do this well, there was a story floating around when I was a loan officer that this individual had decided to start her weekend, early on a Friday and decided that being inebriated was an appropriate choice. And that in this inebriation decided that going to the mall was an awesome idea. She gets to the mall, still in an inebriated state, and evidently that inebriation also made her impulsive. And so this individual buys a $600 puppy from the pet store on a payment plan at 24% interest. And so after the weekend passes and all the snuggly new found benefits of having a puppy in the household are kind of wearing thin, she realizes, maybe that wasn't such a great idea. So she investigates some of the local banking options and says, well, the worst rate on an unsecured loan in this area is 18%. So if I refinance my dog, I can save 6%. How many things are wrong with that conversation? Because I can tell you the loan officers in that area, in my bank alone, we kind of had a reaction that kind of resembled the dog, kind of like, So yeah, so sometimes you wish you could check the mental capacity box or common sense box for some folks. It doesn't always boil down to the income. Her income was fine and she could support the payment. It just wasn't the right decision criteria to start with. But this collateral, speaking of things that you could pledge as an asset for security. The more things that you can add security to your credit relationships, the better the bank feels about loaning you the money. You're less risky. So what can you do? Can you do a collateral scenario as a dog? Maybe not. But this is a really common scenario when you have car loans. So the bank that loans you the money to buy your car takes an ownership interest in the car until the car's paid off. Same deal with your home mortgage. The bank takes an ownership interest until the house is paid off. So you're offering up the asset as a pledge that your promise is good, that you're going to maintain good credit, you're going to make the payments on time, because they fronted you the money to make these particular purchases. The capital issue kind of looks at your balance sheet, and it doesn't really matter if you're doing a revolving credit application or an installment credit application. Part of that application is going to be labeled assets and liabilities. They're going to take stock of what you own versus what you owe. And here's the thing that you want to present to the banker's eyes. You want to present a gap between those two, and you want the gap to be positive in favor of your assets. You don't want to necessarily have those values so close together that it looks like your entire lifestyle is propped up in debt. I've known some individuals who had their own businesses and made in excess of $300,000 a year, and they had $1 of debt for every dollar of assets that they owned. There were people that worked in local manufacturing plants that made $15,000 to $18,000 a year that had more financial freedom. So it's not about how much you bring in at the end of the day, it's how much you tie up. And so the idea is to not tie up so much money with credit products. The conditions generally relate to how's the economy doing? How does that translate into the interest rates that you're going to see? And what kind of interest rate can you negotiate? One of the things that cracks me up, my son was really tuned into commercials. Like, I think if they could translate his homework into commercials, that we would have a much better time getting him to actually do it. But he's very enchanted with the latest Experian commercial. Have you guys seen it, the credit swagger? Lady walks into the office, the guy says, well, let's see what we can do for you. And she puts her feet up on the desk and says, oh, no, I know my FICO score. The question is, what can you do for me? And so he's laughing hysterically at this commercial. He says, Mom, that is so you. Like, no, it's not. I don't put my feet up on people's desks. That's rude. But I like to control the conversation because I like to be able to negotiate the interest rates based on having managed credit products well. So my advice to you is, if you're trying to get started, I would be remiss to tell you that everyone has a great model. I've talked to students in every semester that I've taught, and I can tell you that parents sometimes are the worst money managers. And sometimes their students feel like they are managing their parents or parenting their parents. So starting small might be a smart step for everyone, whether you have a good model or not. I would just caution, if you're going to start with a credit product, probably starting with a credit card is not a great idea. Start with an installment credit that has a defined payoff period. That just makes a lot more sense in terms of building the behaviors and the discipline and putting it in place to get rid of that debt a little bit faster. So tie your first credit experience, if you will, to a need rather than a want. So we have a nice chart with what the needs versus wants are. But let's say that you bought your first car in cash. Maybe you bought something from CarMax, maybe you bought something from Craigslist, but you've invested in the car, maybe it just needs new tires. So it's a legitimate need. Maybe winter's coming, you need new tires to get back and forth to work. That might be something to say, hey, I can pledge my car as collateral. I need to borrow the money to put tires on it. I think pretty much any credit officer would work with you in that particular scenario because you've made the need the focus, and it's a more legitimate reason to give someone a loan. The save more, borrow less. The investment in the vehicle says I've disciplined myself enough to save to pay for that asset in cash, so I don't need to borrow money for that. I'm already invested in this transaction. So anytime that you can add a down payment, it's why banks like to see 20% down payment on a house. It makes it harder for you to walk away from that relationship. It gives you more incentive to treat it correctly and pay it on time. The avoiding credit cards, the bane of my existence in talking to people who are trying to get themselves established. You are going to get pummeled with credit card offers the minute you graduate because you're going to have real income for the first time in your life, and they're literally banking on you not knowing what to do with it. So they're going to put offers in that are, the applications are actually even pre-filled. So all you have to do is sign it, send it back in, and you'll have a credit card in the mail in a matter of days. And depending on what magazine subscriptions you subscribe to, you might even get an increased number of credit applications. Try to say no. My biggest public service announcement, if I could offer one, is anytime you're in a retail setting and someone says, would you like to save 10% today and open a credit account with us? Just say no. It's like the 1980s version of this is your brain on drugs. Just say no. Those store cards are a bad deal every day of the week. They're in excess of 20-some-odd%. It makes no sense. So if you must have one, have one. So pick the store that you frequent the most and kind of limit your behaviors to that. My personal preference, Kohl's, I save the 30%. But here's the trick. You got to pay off. In order to get 30% off discount, you have to use the card. But it doesn't have to stay on that card if it's a higher balance than your regular card. And I generally like to pay stuff off the month that I charge it. So I take personal pride. It's like a badge of honor to pay stuff off and not let the credit card companies make money on me. It was like my whole strategy in college. I never carried a balance. And they always tried to charge me annual fees. So I'm like, taking my business elsewhere. So if you have to have a store card, one, but pick one. Don't get scattered. It actually makes you a bigger target for identity thieves to have your financial life fragmented because you can't possibly pay good enough attention to all of those accounts out there that you can actually keep tabs on all of them. You make yourself a bigger target at the end of the day. So in terms of the other credit cards, I would have maybe one regular credit card that has some kind of loyalty perk attached to it that's actually useful to you. I personally like cashback bonuses, but a lot of people that travel prefer cards that have frequent flyer miles. So if that works for you, that's great. Just try not to carry excessive balances. It will eventually hurt your FICO score, which I have profiled here in the pie chart. The amount owed relative to the available balance should never exceed 30%. So you don't want to look like you're living on your credit cards, although an astounding number of Americans do. The average American household has $15,000 in credit card debt. It would take probably roughly 40 years to pay that back if they were just paying the minimums. So we're trying to help you not get into that same debt trap and to make yourself pack a lot of punch when you're trying to control the conversation by way of your FICO score. The other thing to do with your FICO score is to pay on time. If you're trying to do credit repair or you're trying to establish good credit, those two areas carry 65% of your FICO score. And if you're not familiar with what that is a Fair Isaac Corporation way to quantitatively analyze you as a client. So it takes some of that emotion out of the decision-making process. It takes it out of the good old boy network that may have existed 20, 30 years ago in lending. It stops people from profiling to some extent, but it tells a story. And so what I wanted to kind of convey as my parting words for this part of the presentation is to kind of write your own story. It doesn't matter if you have the model or don't have the model. I have students, particularly one that comes to mind from about 2 semesters ago. She came up to me in office hours and she said, Ms. Snyder, my parents need me to, or my mom in this case, my mom needs me or wants me to sign on a loan with her. Mom had credit before. Mom had screwed it up. Mom couldn't get a loan in her own name. So she needed her student, whose credit was new and unspoiled and still reputable, to be on a loan with her. What do you think my response was? Absolutely not. Unless you are completely committed to paying the entire thing back, that is a bad move. Stop the enabling behavior. If you need to make me the bad guy, make me the bad guy. I'm used to it. I used to have to tell people no all the time relative to money. But protect your credit score because it opens doors in terms of getting you homes. It opens doors in terms of buying you vehicles. It opens doors in terms of just creating the kind of freedom that child's mother will never know. So I encourage you to kind of take this advice and the advice of Emily in terms of debt restructuring and folks in budgeting, just to write your story and write it well. Thanks for having me.